Sorabh has 20 plus years of experience into investing, M&A, financial research. He's currently running a private angel network and advising startups and mid-sized firms on strategy, M&A, and fundraising. Saurabh spent a significant part of his career building and scaling up Copal Partners, which was a leading financial research firm delivering research and analytical services to clients across the globe. He played a key role in the sale of the company to Moody's Corporation. Saurabh holds a MBA from IIM Calcutta. Welcome, Saurabh, to the episode.
Thanks, Kulmani.
I think Saurabh and I've known you for many years. I think you didn't know me because I was very junior at that time.
I know you for at least 15 odd years now.
So that's a good thing because I always thought that you didn't know me at that point. So that's a surprise. We'll start from the early phase of your life. How was it growing up? Maybe till you went to college and education wise. Maybe you start with that. Maybe some early life experiences which shaped your personality. And later some lessons which you carried with you when you went into the professional life from that.
Sure. So early childhood, I would say, has been pretty blessed for me, right? Coming from a middle class family, but again, we had ample of everything that's in. So we never got into a situation where we had something like a lack of something. So once you've got that kind of a easy life, building out, let's say, things on your own, plus let's say going to good colleges and having good education, I think my childhood that way was sorted. And once you come from that zone, chances are that at some point of time you meet a lot of guys who are inclined towards investing. And that might be the one of the triggers for me to get into investments. Plus, once you look at the positive side of the society where people are well to do and they are growing through either their hard work or their investments, you just tend to get a sense about how to do things in a good manner. And a lot of these guys unknowingly tend to become your mentor because they are shaping your life at the early stage.
Right. And any lessons which you carried from either your college education or your MBA to later in life about risk, let's say.
Right. It's actually, once you look at me currently, it's a culmination of a lot of factors in terms of education, plus, let's say, the kind of people I interacted, right? So, education definitely had a big role to play in my early career or even in my late career. Because a lot of time when you are getting into investing per se, right? So, till the time you don't really have the right set of tools or right kind of education, chances are you would start learning everything on your own, right? Which takes time. Sometimes you make costly mistakes, which may shake your confidence. In my case, I think again, I have been lucky to get the right kind of education. I did my MBA in finance, right? So, a lot of those concepts which are slightly difficult for people to understand, I got to know very early on in my career. So, I think I did have a solid education, which actually propelled me towards investment side.
Right. So one of the lessons which I carried from my college life into investing, because I was in the US for college, so I financed part of my education through credit card debt,
Oh.
and I and I learned about interest rates and what is the cost of missing any of the payments and what is important needs to be done, right? So and then initial probably doing minimum wage jobs, etc. So learned that lesson about what are the priorities and what is the cost of funding. Even
Yeah,
before I knew cost of capital and knew how much or how do you manage personal finances,
correct,
right?
correct.
Because if I was at home and going to college here, I would
Hmm.
not have to worry about personal finances that much,
Right,
right?
sure.
But that lesson has stayed with me, right? So I
Right.
always I'm little careful about what is your cost of capital, right?
Right. So, two, three things which actually probably I could talk about in my early days of life, right? So, I never took education loan because my father sorted out the money for it. But yeah, obviously we could have taken a low cost education loan at that point of time, right? But my father, I think, had a big influence on me because he had all these LIC policies, his FD books, RD books, where he was trying to manage investment. So for me, coming from that kind of a family, investment was something which was anyway there. So I learned from my father. So for me, the investment wasn't something very different from early stage because you tend to become very comfortable with all this investing in case it runs in your family. Secondly, because my father focused on saving a lot because his salary wasn't that high compared to today, right? So we got the value of the product early on. So the idea was that in case you're going to college, what you need to see is that it doesn't strain the finances at home. So you actually became a lot more efficient in the early stages of your life, which carried forward in my investing style as well.
Right. So from fixed income now to venture, because that's I would say the other spectrum of risk return graph,
Right.
right? You are the high risk spectrum. So how do you see some of those lessons now applying at in VC investing? Because here, as some people will call it, zero IRR investing, right? I mean, I don't agree with that. One of the things which I noticed about your approach to investing, and I think you also mentioned that too during your annual day, was that AUM versus ROI. You are not interested in growing the AUM, while you are interested in managing the ROI on your portfolio level, right?
Right. Right.
So I think that that's also a lot of people are looking for to grow AUM while you are looking to maximize ROI in that case.
Right. Yeah. What we feel is that because we are a private network, capital is always constrained. So we can't really just spread out our capital. For
Mhm.
us, the ROI matters versus AUM in that case.
Right. And after your job, right, how did you start your investment journey? You were investing before, maybe in public markets, maybe in startups as well, but
Sure.
then you went full time into
Right.
venture, right? So how did that transition happen?
Got it. So it's a function of the kind of jobs I did. So initially, I started my career, post MBA career with Crystal. So there I got a sense about fixed income to a decent level because we were dealing to products like government bonds or let's say treasury bonds or even private credit and all that. And there you need to see that the check sizes were large. So
Right.
when I started my career in 2002, that point of time, a GSEC, a minimum lot was about 5 crores. Because
Right.
the yields are so low that you can't really work on a smaller lot per se, right? So there you got a sense about how the high volumes can be done in the system. But then once I joined Copal in my last stint, there I saw other side of the world where it was investment banking, it was private equity. And there you realize that there I think the velocity of money is a lot higher in terms of let's say the kind of percentages you can make on your portfolio, and then you don't really need to play in larger volumes. So that thing starts becoming exciting because inherently, let's say, when you look at it, you tend to chase alpha or you want to chase a high return, which gives you kicks, right? So at that point of time, the fixed income market started seeming probably, let's say, less risky but flattish,
Right.
and you start getting enamored by things like private equity because there you see the percentages very differently,
Right. Right.
and that attracted me towards private equity side.
Right. Right. So I think that's also something which investors need to understand is the risk return spectrum.
Sure.
Like which niche are you playing in, right?
Yeah.
Government bond may be a crowded market and low yield market because of safety and other issues. But a lot of people I see don't think that way, right?
Right.
So it comes down to mental models or developing frameworks, or you have those concepts clear or not.
Right. Right. Secondly, I think I feel people don't experiment much in the financial markets, right? So
Mm.
for me, while I was working, because of a lot of restrictions, I could not have even traded in public securities. So most of my money was lying into fixed income products like your bond funds and all that.
Right.
Plus, let's say in equity mutual funds. Now, in that case, your money grows, but your probably the intellectual capital doesn't grow because someone else is managing your money.
Right.
So once I decided to leave the corporate job, first thing I did was I started dabbling into newer asset classes. So I got into equity, the public market equity. So I started trading directly just to see how things work. I went into from investment to becoming a trader in terms of doing intraday, which is slightly high risk, but again, the velocity is high, so you
Right.
start seeing how to scrape the money out of the table per se. So that was the second thing. Then I started dabbling into options and futures again, because that's risky, but then the rewards are high. So once you start looking at multiple asset classes, then you realize that which asset class actually works with your temperament.
Right.
So you can make money anywhere, but in case you are worried about losing money, then potentially option trading is not for you. But
Hmm.
in case you do five bad trades and you still can sleep well, then probably come to option trading, for example. So
Right.
once I looked at all these asset classes, so private equity was another asset class which I dabbled with, and somehow got the liking to private equity more compared to public market or options trading.
Right. And the thing with private equity, and VC is a subset of private equity, right? For all practical reasons, is it's very difficult to screen for targets, right?
Mhm.
Because in public markets there's a lot of data available, and you can go out and do your own research. But when you talk about private opportunities, it's very difficult to find good opportunities before it becomes a trend or a fad where everybody is talking about it, right?
True.
So the recent fad, which I remember, let's say anything, let's say crypto or any other asset class, which is by the time you hear about it, there is no value left for the investor,
Sure.
because if you're coming in at that point, it's already too late.
Sure.
So when you think about screening, let's say in private equity for startups or even mid-sized companies, how do you think about screening, right? Because now within private, obviously you could have a sector or other things, but as an investor, what are the criteria you are looking for when you're screening for
Sure.
opportunities?
So one of the things which probably I would say is that private market is not so opaque as people think it to be.
Mhm.
The problem is people don't ask for information, because when I look at any of my private companies, mostly the kind of information I have access to is better than the public market. Because once you are trying to invest into private markets, you need to really dig for information. Information is available to a
Right,
large extent. Now, in case information is not available in the company, then that's the company you should avoid anyway, because then you don't know what's happening out there. So once you get into these private information places, once you've got the information, it becomes slightly easier decision to invest in a private market, because the difference is that in case I'm buying probably a couple of crores of Infosys shares, right?
right,
No one is going to talk to me about it from the company. But in case I'm putting in a couple of crores into a private company, I have got access to the complete top management to discuss and see how things will move, because then you get a feel about the company more.
right,
And that is something I think which I find enriching in terms of having a much better kind of control on the outcome per se in a private market.
right,
So for screening the companies, yeah, it's a hard work, because a lot of time when you talk to the company, their numbers are not clean, right?
right,
So you need to figure out whether it's a clean number. So that's one positives of a public market, that a lot of information which you get tends to be clean, and you can actually rely on that numbers, right? But in private market, you need to dig deeper, and a lot of time, because you are investing early on, a lot of it is your conviction about the segment as well,
right,
because the markets are very niche sometimes and there is not much research available, and even founders are somewhat clueless about how the company will shape up. So a
right,
lot of time your experience tend to come into these kind of
right,
companies for screening as well.
right. And you mentioned about the management, right? The other side is that the future outcome is so much, high dependent. The dependency on the founder is extremely high, right?
Right.
So I'm sure when you are meeting the management, you're also screening them for certain traits or certain behavioral traits.
Mhm.
So what are those positives or negatives about the founders
Sure.
when you're thinking about potentially investing in a company, in a private company?
Right. So it's a lot more behavioral compared to probably technical.
Right.
So the founder needs to be ethical, right? So we don't do very heavy diligence on the companies, but in case we find anything which is not true about the company told by the founder, right? That's the point we exit or we
Right.
don't invest out there. Secondly, behavior wise, because that's the kind of founder you need to really work through for next 7 to 15 years, right? So behaviorally, the person needs to be courteous, right? So
Right.
we try to stay away from guys who are kind of arrogant,
Right.
right? So the whole idea is you want to make money, but the money making process needs to be positive for you. Apart from that, you need to see the management team, the top founding team you are interacting with, if they've got the right skill sets and the temperament. Now temperament becomes a lot more important because running a large company is way different than running a very small company, right?
Right.
And even potentially can run a company which is doing 2 to 5 crores in revenue because everything is small.
Right.
But once you start getting into, let's say, lots of employee hiring, a lot of, let's say, cross-state GSTs coming in, lot many vendors coming in, how the founders hold up in terms of the growth of the company, because it's not easy to manage a 10, 20, 30 crores revenue kind of a company. So if the founders have the skill set, or at least that what do you say, you see that there is a potential for these guys to run a large company, that's the point you want to get into that company. So a lot of founders probably fail at that test as well.
Right.
And then you need to see the fire, because once you're starting a startup, right, and the valuations are out of whack, right? For example, in case there is a company which is doing 100 crores in revenue and 10 crores and potentially PAT,
Right.
public market will give them about 250, 300 crores in valuation. That's
Right.
a range, right? But if someone comes in with a 5, 10 crores revenue and asks for a 200 crores valuation, that's the point. A lot of it depends upon the founder's ability to scale. And that becomes the key criteria for us to see if there is enough hunger in the founder to grow to that level.
Right, right. So when you think about that potential, right? Let's say we're looking at founder A versus founder B. When you're making that judgment, whether
Sure.
founder A has that potential to, make it big, grow the business 100x or 200x, and also have the ability to manage the ops side,
Sure.
right? So what are those traits which you will look for when you talk about, that potential?
So mainly it comes down to maturity and experience, right?
Right.
Initially, we got somewhat carried away with the media narrative that there are two young guys just out of college build a $1 billion company, right? Now, those kind of things tend to happen, but that's not the target set for us.
Right.
What we are looking for a solid, stable business which reflects in our portfolio. Now, for that, you really need the kind of founders who have seen or built something like that, either as an employee or as a founder before.
Right.
Now, once you have worked as an employee, the negative side sometimes what we see is that people are dependent upon other persons to do the base work, right? So you are a VP in a large firm. So you do have a large organization managing your HR, finance, even your sales and all that stuff. Now, as a founder, you need to manage everything on your own. So do you have that drive to run everything on your own? So that's the flip side of go into the seasoned professionals. But over the last 8 years, right, what we have seen is majority of our winners have the founders who are experienced, and majority of the companies which we lost are the guys who have probably spent 4 5 years post college into running their startups. So this is not true for the general ecosystem because I did not do analysis, but based on my experience, that is what has happened in our portfolio. So naturally our portfolio is now shifted more towards experienced founders.
Right. Potential, right?